I'm very happy to say bonds are finally exciting again. So we believe that we're approaching the end of the Federal Reserve's monetary policy tightening cycle. Throughout 2022, policy tightening had the effect of materially raising bond yields as well as impacting the pricing of risk throughout financial markets. So we're talking about equities, credit spreads, FX and so on. As inflation is slowing and the growth is expected to become the focus for markets again, we expect interest rates to move gradually lower into the end of the year.
We do not anticipate a direct impact to any of the fund's exposures through this process, as it does not invest into the financial sector. We expect that the instability seen in the financial system in March 2023 will ultimately have the effect of substituting for additional interest rate hikes by the Federal Reserve. Expressed another way, we expect that the tightening of credit standards and future loan growth will have the impact of tightening financial conditions, and means the Federal Reserve will not need to take the cash rate as high as it otherwise would have.
We can expect many companies have ample cash flow. Many companies belong to stable industries that are closely related to our daily lives. Think of telecoms, utilities, logistics, transport and so on. As a result, infrastructure-related businesses tend to be less impacted by economic trends and market cycles due to their non-discretionary nature.
Many infrastructure-related assets are regulated in nature and have long asset lives, and so require long-term debt to be raised to fund these investments. This means that infrastructure-related bonds generally have higher interest rates and therefore offer higher yields to investors. Secondly, infrastructure-related debt's long-term nature is reflected in the fund's longer duration of almost 9 years. This long duration profile means that the fund can perform strongly when bond yields fall, as longer maturity bonds have greater sensitivity to falling yields. With inflation falling and economic growth expected to slow, we believe this interest rate profile can be beneficial for investors and is appropriate at this point in the cycle. Additionally, the fund invests in quality infrastructure-related bonds that are only investment grade, so BBB- or above, which historically have had much lower default rates on average and are more appropriate for an uncertain economic environment. Infrastructure also provides essential services, and so it tends to be more stable in economic growth slowdowns. The performance of the infrastructure bond index during the 2008 financial crisis and the March 2023 also highlights the outperformance of infrastructure bonds. Stability of infrastructure is also evident in economic downturns. One example is the stability of demand for telecommunications and broadband services, even as the economy is impacted through the crises.
The portfolio is managed differently to the benchmark in that we adopt an active investment approach to managing both the credit and the interest rate profiles of the portfolio. There are 3 active return levers that we can use to manage the portfolio: sector selection, security selection, and interest rate management. As opposed to following the benchmark, we would use these levers to reflect our latest views on markets, sectors, and securities. We believe we're currently in the midst of a growth slowdown and are approaching the end of the Federal Reserve's monetary policy tightening cycle. As such, the portfolio has been actively positioned as follows, which we believe can add value to the portfolio's active returns. In interest rate management, we are maintaining a tactical overweight in duration. This provides protection for the portfolio in a growth slowdown or recessionary environment and can benefit returns as central bank tightening approaches a pause or an end in the near future and yields fall. In sector and security selections, we are focusing on issuers with stable cash flow generation and in more defensive sectors such as telecoms and utilities. And we are generally underweight issuers with more uncertain discretionary spending exposures, large capex spending needs, or that are burning cash for growth, such as some media issuers. After a period of rapid monetary policy tightening, we appear to be approaching the end of this tightening cycle, which means a more stable return profile for bonds. Investors have been very underweight bonds since at least 2022. As the deposit-driven concerns in the banking system took hold in March 2023, investors rushed to cover this underweight positioning in search for safer assets. We expect more flows into the asset class in 2023, which should be supportive for total returns. Within investment-grade bonds, the infrastructure sectors should be a beneficiary of these flows, given their more stable cash flow and fundamental profiles. In particular, we expect long-duration infrastructure bonds to be especially attractive to investors as economic growth slows further. There are also a number of supply factors likely to prove supportive for infrastructure bonds from a pricing perspective. We anticipate that net issuance across the infrastructure sectors will decline in 2023, resulting in fewer bonds available for purchase. Whilst issuance from utilities is likely to increase this year, this is more than offset by reductions across communications and media, transportation and energy, with the latter sector again expected to see negative net issuance in 2023. In addition, many issuers continue to favour debt or leverage reduction, including buying back bonds. This further limits net supply and is supportive of total returns going forward.
In 2023, we currently anticipate we will see economic growth and inflation to slow progressively into the end of the year, the monetary policy tightening cycle to come to an end as we approach the likely terminal cash rate in the US for this cycle. We also expect valuations across asset markets, for instance equities, bonds and credit, to begin repricing these risks, with cyclical industries more exposed to earnings-related risks. From a credit perspective, this warrants a more defensive stance at this juncture. We aim to maintain the yield of the portfolio at or slightly above that of the benchmark, and tilt the portfolio to have a lower sensitivity to credit spread movements than the benchmark. In managing the interest rate profile of the portfolio, we are currently overweight duration exposure to reflect the anticipated economic slowdown into the second half of this year, and the likelihood of inflation to continue drifting lower in the coming months and quarters.
I'm very happy to say bonds are finally exciting again.
It's likely that we're moving into a more volatile period, but we'd encourage investors to think longer term in the way that they shape their portfolios, and we believe that the fund will be a good addition to their portfolios for this environment.
ファンドの目的、特色、投資リスク、留意事項、本映像で使用している指数について、ファンドの費用、本映像にかかる留意事項については、表示画面を一時停止してご覧ください。